Good evening, everyone, and thank you very much for taking time out and joining us this evening for the second edition of our Thought Leadership Conclave, White Oak Quarterly Connect. This quarterly event will help you engage with our investment leadership team and our founder, Prashant Khemka, where they will share their investment outlook over the next 90 minutes. On behalf of everyone here at White Oak, I would like to express our gratitude and thank all our investors for entrusting us to manage their wealth. It is indeed an honor and a great privilege. We greatly appreciate everyone who has joined us today for their interest in White Oak. We would also like to thank all our distributor and advisory partners for their continued support over the last 3.5 years. With all your support, I'm very happy to share that the AUM we manage now is over 3.8 billion US dollars, or approximately 28,000 crores, all of it in long-only Indian equities. 80% of this AUM is from our offshore investors, large sovereign wealth funds, endowments, pension plans, and high-net investors across Europe, Asia, and Americas. And 20% is from investors in India in our PMS and AIF strategies. We have also expanded our presence geographically and are now present in 9 cities across India. This evening, we have a very strong lineup of investment professionals who will provide insights. Starting off things will be Prashant Khemka, our founder, who will provide an update on the portfolio and also give his investment outlook. This will be followed by a session by Ramesh Mantri and Ayush Abhijit titled Decoding IT Services, where they will provide their thoughts and insights on some of the key debates in the sector. We will conclude with a panel discussion and a question and answer session where our entire senior investment leadership team will answer all your questions. Before I invite Prashant to start things off, just would like to inform everybody that they can ask their questions in the question tab on the home screens. Over to you, Prashant.
Thank you. Thank you, everyone. Thank you, Vivek. And thanks for joining us today on this installment of White Oak Quarterly Connect. As Vivek mentioned and like to reiterate, we really thank and appreciate the time you've taken to join us today, and also the confidence and trust you've placed in us in investing your capital with us. What I'm going to kick off today with is a couple or three topics that might be top of investors' mind, particularly as it relates to macro developments during the quarter as well as at current time. Before going into individual topics, though, I would want to reiterate and maybe recap what we discussed as the main agenda item during the last quarterly call, because that remains as relevant now and in fact remains relevant at all times, particularly as a caveat when we are going to discuss about macro matters, be it positive or negative. The importance and the biggest lesson from 2020 was also personally one of the most important lessons, if not the most important, that I've learned over my lifetime or over 3 decades of investing in the equity markets, is the futility of predicting investment returns based on macroeconomic worries and events. Okay, lesson 1, as you will remember, there are these perennial macroeconomic worries about interest rates going, Fed increasing rates, decreasing rates, or GDP growth percentage point higher or lower. Those are, as we discussed last time, colossal waste of time. Last year was a great example of that. Lesson 2 is unknown risks of the kind of pandemic are inherently unpredictable. Even if you knew exactly what is going to happen ahead of the pandemic, but you just didn't know what the market is going to react like, there is no way one could have made money. In fact, the risk would have been one would have lost, as many people did, by committing the mistake number 3, or the key point of the lesson number 3. Investment, it's one thing to worry about macro, talk about macro, discuss macro, as we are going to do for just self-education purposes and staying on top of what's going in the world. But the biggest downside or risk is if one starts taking investment decisions that are bereft of bottom up investing and are instead driven by these macroeconomic considerations. And again, these could be positive. Just because there's positive macro development does not necessarily mean one goes and jumps into the market whole hog and lever up, nor does it make sense to, in our view, withdraw when there are negative macro developments. Each of these kind of actions are fraught with very high risk of absolute as well as relative losses. So, with that as caveat and backdrop, let's now move to some of the key developments during the quarter. First, to start with the positive, the biggest positive development during the quarter from an Indian equity market perspective or corporate sector or economy perspective is the budget, which is widely regarded, and we agree that it was one of the most pro-reform, pro-growth budget, at least in over a decade. What were the key highlights of many? But if we were to just capture that into few points, to us the most important was the tax aspect of it. First of all, the fact that there were no changes, no material, no significant changes to individual and corporate tax rates, that itself is a big positive. It's only in India, I believe, where there is expectation of tax changes every budget, every year. And there are indeed tax changes every year budget. Worldwide, we develop, particularly in developed markets, there's a lot more stability to tax regime. For years, the tax rates don't change. Yes, they do change from time to time, but not there isn't an expectation every year of tax rates changing. It just introduces a lot of uncertainty in planning, planning capex, planning individual lives and whatnot. So that stability is very good, that the tax rates weren't uh, changed. Also, there, besides the absolute rate levels, what was positive was there were certain administrative reforms, like reducing the period of time uh, to what the department can go back to. I don't remember the specific number of years, but the time bar limit was reduced, which is very positive, and many such other developments and incremental positive steps were taken in the budget that reduces the compliance burden on individuals and potentially reduces the harassment that individuals might suffer. Besides the tax aspect, what was very big was the privatization announcements. Now, obviously, the real test would lie in what is actually and how it is actually implemented. At least the intent that is announced, if that were to follow through, even to partial extent, it's a major turning point in government's thinking, in not just BJP government's thinking, but just generally the government's thinking. The last time anything close to privatization was conducted was in the early 2000s during the Vajpayee government in 2003, 2004 time frame. Divestments are not privatization. Privatization means ceding control, giving up control, to let go, which is very difficult for governments to do, because governments like to keep everything in their control. So if the government indeed follows through with its announcements in the budget of letting go and privatizing, beyond mere divesting, privatizing a whole range of PSUs, that would be hugely positive for the economy, for us all citizens of India, and far it will be positive far beyond just the equity market. So again, as I said, let's watch that carefully. Personally, I would say that's one area that I'm most uh, closely uh, following and hopeful that government would follow through on those. They have announced some definitive dates as well, that by September end they expect to close the privatization of Air India and BPCL. If that indeed comes through, even with a small delay, that will be a huge positive. But it has been some time. It's been a couple of years that these been talked about. So right now really keenly watching actual implementation. No reason to doubt it, but would love to see that happen finally. Infrastructure focus was very clear as well in the budget. Huge amounts of capex announced. New financial institutions or development financial institution announced as well. And that again, implementation remains to be seen. But what is currently being very well implemented is the production linked incentive scheme, which wasn't the first time that the budget announced. It's been underway for over 12 months. And I think this is one of the best implemented schemes of this government as far as the corporate sector is considered. In several segments like mobile phones, it is already underway, and companies have already started setting up factories, and several tens of thousands of jobs it has already created. So these are, in a nutshell, besides other announcements like raising of for insurance companies, raising of ownership limits for foreign investors to 74% is a big positive as well. Over time, should attract more insurance companies to set up shop in India, which is positive for consumers who want to buy insurance, also positive from a job creation perspective. Similarly, the limit for ownership was increased for in defense sector, which is very positive. Nobody likes to come from outside India. I mean, it's a big hurdle if you cap ownership to 49%. I mean, there are a lot of business owners or people who run businesses here on the call. I mean, it's not that exciting. It's the difference between 51 and 49% is huge. Very few on the call here would want to enter into a venture where they own 49%, right? So these are unnecessary hurdles that country has endured for a long period of time, which has resulted in tremendous loss of output, tremendous loss of jobs, tremendous loss to exchequer, tremendous outflow of um, dollars in importing. We've been importing so many tens of billions of dollars worth of defense equipment, and still we had restrictions such as 49% on foreign players, which just didn't make sense. And fortunately, the government has addressed to considerable extent, and over time maybe go further down that line. So those are several other positive um, announcements in the budget, and as we said, now the implementation is what we are closely watching. Recently, in terms of other developments on the negative side or worrisome side, is the huge surge in COVID, the second wave for India, if you will. If we go to slide number 55, I believe, or 45, you'll see from the shape of the curve, which I'm sure most of you are familiar with, we are all watching. It's been a very sharp and sudden surge. We all were somewhat complacent, I think, until February or March, uh, because it seemed like India has endured the worst last year, and for a variety of reasons, we've come through it relatively unscathed. But this second surge is turning out in some ways to be more problematic than the first one from a humanitarian perspective, from a health and safety perspective. Not to repeat the cases, you all are aware, crossing 2 lakhs yesterday. The death count has crossed 1,000 and is similar to what it was at the peak. And from a health and safety perspective, it could get much worse than what it was the first time around. And in that perspective, it is unfortunate and sad and troubling as an individual and as a citizen. However, if we come back on a discussion to how it pertains to the equity market, uh, we believe, and as the market is showing with some little bit of volatility here or there, we don't think that we are going to see um, anything like the volatility that we saw last year, or certainly not the downdraft that we saw last year, where markets were down more than 30% in March. In fact, the markets bottomed on March 23rd, when I think the lockdown became effective or something had just become effective. The number of cases or the number of deaths were, I think, on a daily basis still in single digits, right? And then, for a variety of reasons, market rebounded. Now, why the not variety of reasons? Let me tell you the key reason we believe it's because the market back then started getting a hold of, or started believing or started gauging that the lockdowns would not be indefinite, that the mortality rate is too low of this virus to warrant indefinite lockdowns, because countries and governments in the West were already starting to talk about opening the lockdowns. So, what's very different today versus a year ago is importantly that a year ago in March, it seemed like a bottomless abyss, bottomless pit. There seemed no end, no solution, no way out. If you imagine, take yourself back in March of last year when virus was rampant all around the world. It was still at very early stages in India, but still the worry was there is no vaccine, no medication. Mortality rate from reported numbers look like it is 4 to 5%, because there was a lot of underreporting and absent data and understanding and knowledge. Even if you combine these two facts, that let's say mortality is 2%, not even 4 5%, let's say mortality is 2%, and there's no vaccine, that means 2% of the population can get wiped out, right? And that is too high a mortality rate for people to take the risk of going about life in a normal manner. And what that would, if that were to be the case, 2% mortality and no vaccine, then extended lockdowns could have been there for a very prolonged period of time. I mean, there's no answer to how mankind would come out of it. Fast forward to today, we do have several vaccines that are effective and highly, highly effective. When you hear about 60% effectiveness, 80% effectiveness, 90% effectiveness, these various effectiveness figures are to do with risk of hospitalization and risk of severe disease. Almost all these vaccines are nearly 100%, not 100%, but nearly 100% effective against preventing death. So we have an effective solution that has already been found, which wasn't the case a year ago, and that is huge, huge, development, which happened early November last year. Obviously, people market doesn't wait till Pfizer announces that this vaccine, or the CDC, the US government or the health authority announces that this vaccine is effective. The market is already ahead of market, knows how the trials are progressing. Even if the trial data is not published, market knows what the trial data is going to say when it comes out. So that's why the markets had done a lot better. And since November, the markets did well as well when it was formally approved, because it marked an end to the uh, high tail risk, which is that there would be possibly no solution. And by the way, during this time period, what also became apparent is that the mortality rate is not in single digits, 1, 2, 3% or so. The mortality rate seemed very high early on because the number of cases reported were extremely low. Doctors and hospitals didn't know how to treat the patients and whatnot. What is now the situation? It seems like, at least in India, mortality rate is more like 1 in 1,000 or 1 in 2,000, because again, the underreporting is very huge. But even around the world, it is a fraction of a percentage point, the mortality rate. So today, the situation is that mortality is far lower than earlier feared, and there is a vaccine which provides an effective solution to this. So combination of these two is far different today than what it was a year ago. So where we are today, over 100 million doses have been administered. So about 7 to 8% of the population has been administered doses. We have capacity of 100 million doses a month, which is likely to increase over the coming months. Even if you assume 100 million doses a month, at least at single dose, that would mean vaccinating potential of 7 to 8% of the population. So in 3 months' time, we can have 25 to 30% of the population vaccinated, which would pretty much cover the vulnerable section, the elderly section, over 50, over 45 years of section. So it is very possible if you look at the experience of other countries like Israel, UK, US, and all, once that critical mass of vulnerable section of the population is covered, the numbers and mortality drops very dramatically. And then the market also understands that. And that is the reason why, despite this huge surge in COVID, today where the market is, it's 3%, 3 to less than 4% below its high of the year. And at least COVID is not the reason, because we've seen this movie before and things are a lot more clear today. COVID is not the reason to worry about the market. The other factor now, if we were to go to, that is slide number 55, I believe, on interest rate. So the other worry is that the bond rates, what happens if bond rates were to rise? And certainly that is a, big question mark. Nobody knows the answer. Um, is the reality. Um, the fact is that bond rates have, uh, if you look at the 10-year bond rate, has nearly doubled from below 1%. So the bond rates had collapsed post-COVID, and they are now normalized back to what they were pre-COVID at about 1.5%, 1.6% or so. Now, people are worried whether if it continues to rise because of inflation expectations, and that could impact multiples globally. And that is possible. We are saying is there is no way of knowing, no way of knowing for anyone whether these long bond rates would march higher from here or go down from here, go lower from here. For many years, forget years, for over a decade, definitely since Lehman Brothers, I would argue even before, prior to that, leading experts all around the world have been talking about risk of rising interest rates, the long-term interest rates. As you can see on this chart, from 1980, when the light blue line peaked at about 15%. So the US long bond rates had reached 15% in the late 70s, early 80s because of the inflation shock on the back of, sharp spike in crude oil and other commodities. Since then, it's been one way down. And the reason, in our view, has to do with um, the technology era that was, in its true sense, began in the early 80s. Because of rapid strides and democratization of technology. Before 80s, computers were in engineering and science laboratories or owned only by large corporations. PC or personal computer, the big box that most of you would have had as your first computer at home, most of us would have had first computer, democratized computing power. Then in early 90s, we had Microsoft Windows and all, which truly made computers as computers for dummies, right? Otherwise, you still needed to have considerable technical knowledge to use in those primitive, in a way, what today might seem primitive, all those commands on a black screen to retrieve any file. With Microsoft Word, Microsoft Excel, and a whole host of other you know, Windows-based software and applications, the productivity worldwide has shot up tremendously over the last 30, 40 years. It has made possible um, tremendous advance in applied sciences, a lot of developments which may not directly be easy to think of as consequence of this technology development are indeed attributable to these advances in technology. And it's not just stops at personal computer or Windows. We then had obviously internet from mid 90s onwards, and then mobility. We are no longer tethered to a landline phone, and then we have now everything combined: a supercomputer in our hand, which is mobile and connected to everyone else in the world. So all these have unleashed tremendous productivity gains. It has made possible technological advances like, the discovery of shale gas. Shale gas has been there, shale oil has been there for millions of years. It's technology advancements that made it possible and commercially feasible to bring it out of the ground. Solar energy, the concept has been around for many decades, if not longer. Technological advances that made it possible, such that solar energy is competing head on with the cost of thermal energy. Uh, Autonomous driving, electric vehicles, all these robotics, machine driven technology, all these are ultimately, applied developments starting from that spurt in technology, in computing, that we saw in the early 80s. And that is very deflationary. And because it is deflationary, the inflation, longer term inflation expectations have gone down, both of commodity prices as well as wage pressures. And because longer term inflation expectations have gone down, that's why longer term interest rate expectations have gone down. In our view, we are still fairly early stages of this technology era. It's only been 4 decades. Industrial era lasted for nearly 100 years. Technology era might last even longer. But right now, if you all believe, and I know most of the investors I meet are very keen to invest in NASDAQ. So they must believe all the technological advances that are happening around the world. If you do believe in them, then there's a long way to go. And so hard to imagine a sustained rise in inflation expectations. But again, we are no experts. If there were to be a sustained rise in inflation expectations, and when I say sustained rise in inflation expectations, it's not inflation this currently or next year because steel prices or copper prices are going up. It's long term, 10-year, 20-year, 30-year inflation expectations, what matters for long term interest rates, which in turn is what matters for equity prices and multiples. With that, what I would summarize in this is saying that as long as long-term inflation expectations don't materially rise, bond yields are unlikely to materially rise to the extent of impacting multiples globally. But again, these are those things that nobody really knows. It can go either way, and it is one day at a time that you'll have to see how it plays out. So I'll pause there, and I look forward to if there are any particular questions in these regards. And now, in the interest of time, turn it over to Ayush and Ramesh to cover portfolio performance as well as portfolio composition as well as technology discussion, more discussion in technology sector. Over to you, Ayush.
Thank you, Prashant, and good afternoon, everyone. We'll now discuss the portfolio performance for both our PMS as well as our AIF. Starting with the performance of our PMS, White Oak Pioneers Equity Portfolio, which was launched in April 2019, the portfolio has delivered 54.5% cumulative returns compared to 31% for the benchmark, resulting in an alpha of 22.8%. In annualized terms, 24.5% annualized returns compared to 14.9% for the benchmark, resulting in 9.64% annualized alpha. This performance would put us in the top 1 percentile compared to any PMS, AIF, or a mutual fund. Now, let me walk you through the performance of our AIF, which was the first fund launched for our domestic client in 2017. Cumulatively, the fund has delivered 72.6% return compared to 39.4% for the benchmark, resulting in an alpha of 33.19%. In annualized terms, 17.8% compared to 10.5% for the benchmark, resulting in 729 basis point of alpha. Needless to say that the last 4 years have seen a very volatile equity environment. And this slide shows how we have performed across different market environments, both in up markets and down markets. On the right-hand side, you can see that the fund has been able to outperform 3 out of 4 quarters with an average alpha of 240 basis points. So 75% strike rate when the markets are going down. Overall, the fund has outperformed 8 out of 14 quarters, so a 60% strike rate during this very volatile environment that we have seen in the last 4 years. With that, let me move to the attribution analysis. This is something that we have said is the most important analysis of performance and something that many of our global institutional investors ask of us. You will notice here that majority of this performance has come from stock selection. So out of 53.5% of total alpha, gross alpha, more than 100% or 91% has come from stock selection, whereas allocation effect has been a headwind for us, minus 38%. You will notice that stock selection is strong across different market cap segments, 10.2 in large, 34.3% in mid caps, and 47.3% in small caps. Important to keep in mind that the strong performance has come in a period when mid caps and small caps have done extremely poorly, which is evident from the returns that you see for these two market cap segments. Looking at it from a sectoral attribution and perspective, again, strong stock selection driven alpha in pretty much all sectors that has led to the overall performance. Now let me walk you through some of the top contributors and detractors for the portfolio since inception. On the left-hand side, you can see the top 10 contributors. On the right-hand side, top 10 detractors. In the interest of time, few key takeaways from this slide. Number one, you would notice that the contributors are 3 to 5 times bigger than the detractors. If you notice the light green column, these contributors have come from across different market cap segments, as well as across from different industries, and is a testament to the team's superior stock selection capabilities. Thirdly, even the 10th largest contributor, which is Torrent Pharma in this case, has delivered more alpha than what we have lost in our biggest detractor, which is Delta Corp. No single stock has had a disproportionate impact on portfolio performance. You notice that there are several stocks which have delivered strong alpha, and the law of large numbers is well at work. Even on the detractor side, you would notice that there is no single stock which has dug a deep hole in our portfolio performance, which is what you would expect in a manager. And this is a testament to the strong risk management and balanced portfolio construction approach on the team. Now, during the last quarter, a couple of stocks, if I can talk about, which have done really well for us. In particular, Intellect Design Arena on the left-hand side, number 6 on your slide. Intellect Design Arena, it's a software product company, which is a niche in transaction banking software, which is considered to be one of the leading companies in that space. Over the period of time, it has also expanded its software product portfolio in commercial banking, retail banking, payments, and several other areas. The company, in fact, invested more than $200 million over the last 10 years, building this suite of software products. And now it is entering a phase of monetization where it is gaining global recognition on the back of its superior products. And the market as well is recognizing the strength of the business. It wasn't the case 4 years back when we first invested in the business. Many of our clients questioned our decision to invest in this. The stock is up almost 5 times since we've invested, and we continue to remain invested in the portfolio, considering that it still presents a very compelling investment opportunity at the moment. Another stock which has done quite well during the last quarter is Dixon Technologies. Number 5 on your screen, the stock is up almost 5.5 times since we've invested. It is the leading, most successful rather, outsourced manufacturing company in India, spanning across various consumer electricals and electronic categories. The management has done stellar execution by expanding into adjacent product categories, all this while delivering superior returns on capital. And we see a long runway for growth ahead for Dixon Technologies, led by penetration in domestic consumer categories, as well as an attractive export opportunity. With that, let me move on to the portfolio composition. At the moment, in the top half, you can see the sectoral composition. We are very well present across most sectors, including financials, technology, consumer staples and discretionary, healthcare, materials, and others. Two sectors, energy and utilities, that are not present in the portfolio at the moment. No top-down view on these sectors, just that many of these businesses tend to be government-owned enterprises and often fail to meet our threshold of adequate corporate governance. And another business here is Reliance, which we've not invested in thus far, having not been able to properly understand the accounting there. From a market cap composition perspective, bottom left, large caps are about 51% in the portfolio, 29% mid caps, and 14% small caps. For the Pioneer strategy, you can expect this mix to be 60-40 with plus minus 10% on either side. With that, I come to an end of our portfolio performance, and I will now hand over to Ramesh.
Good afternoon, everyone. Today we are talking about White Oak's perspective on the IT services business. From an opportunities perspective, how does the industry look? And our thoughts on valuation, the business model. On the key questions that come around IT services we have on the next slide are, first, is there a long runway of growth for IT services industry? Can IT services industry continue to gain market share? And how does this industry have potential even 10 to 20 years down the line? So that is the key question on IT services. These are the three questions I'll answer initially. So moving on to the first question that we need to answer is, what does IT services companies do? IT services companies, on one side, you have global enterprises, large Fortune 500 companies, the likes of Citibank, Walmart, Boeing, AstraZeneca, right? Who constantly face an evolving technology landscape, who are getting disrupted by fintech, consumer tech, e-commerce, variety of technologies at work, auto getting disrupted by electric vehicles and autonomous cars. On the other side, you have technology companies which make cutting edge technology, the likes of Microsoft, Amazon, Google, Salesforce, SAP. And the technology landscape continues to evolve and change. For example, a decade ago, three of these companies, Amazon, Salesforce, and Google Cloud, were not even relevant in the technology space. That's how the fast technology space evolves. The IT services company's core business is to provide technology solutions to the large global enterprises. What do IT services do greatly? First, for the enterprises, they bring deep understanding of business needs. Number two, they understand the existing enterprise tech estate of these large companies. For example, a large US bank uses 12,000 applications. Such is the complexity in the tech architecture. And number three, they bring deep relationship with stakeholders and enterprises. On the technology side, IT services companies, understand technology and can also use these technologies to formulate business appropriate solutions. And that's why today the IT services industry is no longer a vendor to global enterprises. They are a strategic partner to these companies in the rapidly evolving tech landscape. The business is so sticky that most of these companies, over 90% of the revenues come from existing clients. Moving on to how does the technology industry look like at a global level? The industry is about $3 billion in revenues, split evenly between IT services and engineering and ER&D. The outsourcing in IT services has been larger. About $1 billion gets outsourced. India's share of outsourcing is about $113 billion. So think about it, despite, we've seen Infosys IPO 28 years ago. Even after 28 years of strong growth, we still only have 7.3% market share of global IT spend, only 11% share of the global IT spend. And in fact, in ER&D, the penetration of outsourcing is still lower. And that is why, because ER&D is actually growing faster. So despite 3 decades of strong growth, we still have only 11% market share in global IT spending. Now, looking at how the technology landscape has changed in the last few decades, technology constantly evolves, and the IT companies and their customers constantly need to evolve. Every 5-7 years, there's a new technology that comes, and that's why it's good to be in IT companies business, because your clients constantly need to adopt new technologies. Pre-2000, you had mainframe server technology, then the internet emerged, then the growth happened in the IMS business in India with data centers and mobile app development. And in 2015, we had this big shift in digital technologies relating to cloud computing, big data, UI, UX, right? And I'm sure in the next few years, we're going to see a number of new technologies emerge, particularly on blockchain, IoT. It's often very difficult even to forecast what will be the relevant technology a decade down the line. Sure. So when these new technologies emerged in 2015, right, there was a lot of concern whether Indian IT services can evolve to build capabilities on digital skills. And there were a lot of people who called out the obituaries or the death of the IT industry, particularly from 2000 to 2018, and believed that the global IT services companies and tech companies will take away the industry. The Indian industry doesn't have a future. A number of obituaries were written about Indian IT services. However, over the last 3-4 years, the Indian IT services industry has done a great job of training millions of people in new skills, building capabilities in digital skills, both and have done exceedingly well, as we see in the slide next. As digital technologies have gone mainstream today, while the gold standard of digital technology adoption is Accenture, now even Infosys, as per the last quarterly result, has 50% of the business coming from digital technologies. So the Indian IT services industry has done a great job of evolving to the new environments. And as you can see on the chart on your right, while digital continues to grow in still high 20s even today for the IT service industry, the legacy is declining. And so while your large portion of a business is declining, yet IT services companies continue to grow, as we will see in the next slide. And so what happened in the last 5 years, finally? This is a chart. The top chart is the dollar revenue growth of key IT services companies from India and globally. As you can see, the likes of TCS and Infy have grown at 8% over the last 5 years. And a number of mid-cap companies have grown 2 to 3% higher in dollar terms, while Accenture, which is the gold standard, has grown 7.5%. So Indian companies have kept up with the best digital company around. If you look in rupee terms growth, because as investors, we invest in rupee, we get to see, we invest in rupee assets. Out of the largest 5 IT services companies, over the last 5 years, 4 of them have grown in double digits. And of course, the mid caps have grown 2 to 3% higher. So in a period when IT services industry was seeing existential risk and was going through a disruptive tech refresh cycle, we have been able to grow in double digit. So the question is, what lies ahead of us? Next slide, please. And now we can clearly see that the Indian industry has become extremely relevant with the large deal wins, as you see in the graph on the top right left. Large deal wins have doubled in the last 3 to 4 years. And that demonstrates the ability of Indian IT services companies to adopt and to be relevant to their large clients. The other chart you have is the number of $100 million relationships. They again from 70 have gone up by about 50% over the last 3-4 years. So Indian IT services are gaining market share in the largest, most demanding enterprise tech clients. And we have seen in the last 2-3 years, Infosys and TCS, both of them have won 2 multi-billion dollar deals. Earlier, the multi-billion dollar deals were the forte of the IBMs, erstwhile HP and Accenture. Today, our companies are capable to win these deals. That proves the capability. And the deal sizes have only gone larger, and also tenures have increased. And this is, by the way, also true for mid-cap IT companies that Ayush will talk about later. So overall, finally, looking at summarizing how the IT landscape in India looks at, revenue growth of 25% in the last 25 years, absolutely been a stellar growth industry. Even in the last decade, it has grown at 11.5%. If you look at the, Indian IT exports over the last 5 years have grown by 9%, while the revenue in global industry has grown by 5%. On a 15-year basis, we have grown 10% higher annually than the industry. So Indian industry consistently continues to gain market share in the IT industry. And if you look at our capabilities on ER&D, 47% of the global R&D centers in 2019 were set up in India. Some of the best tech companies in the world, Microsoft, Google, Amazon, have the largest technical setups in India. And no wonder some of the best tech companies in the world, whether Microsoft, Google, or Adobe, have today Indians as our CEOs. Now, there are a few key concerns about Indian IT service industry, and let me address the points for discussion. The first point that always comes up for discussion is whenever US has higher unemployment, the question is, how will it impact Indian IT services industry? First of all, you can't focus on the US unemployment data because an unemployed construction worker or a retail worker or a food services worker can't work in IT services industry. So the right metric to focus is US unemployment in IT services industry. And if you look at the last 5-year average, that's been about 3%. Even in the worst months of COVID, when US unemployment rate went up to 22%, it never exceeded 5% for IT services. For last 30 years, US has been short of STEM professionals. And as you can clearly see, with the Chinese competition emerging, US is very paranoid of losing their tech leadership. Number two, who have been the users incrementally of H-1B visas? As you can see in the table on your right, in the last 5 years, Indian IT have only used 8% higher H-1B visas. MNC IT companies, the likes of Accenture, Deloitte, have increased H-1B usage by 68%. But the lion's share of incremental H-1B visas have gone to US tech companies, the likes of Amazon, Google, Microsoft. So the US requires H-1B visa for their tech companies. And in terms of other issues regarding visa-related risk, one, work from home has clearly proven that offshoring works and it's become more acceptable. The Indian Tier 1 companies have done a phenomenal job of localization with 60% plus localization in the US market. And have also built nearshore capabilities, for example, in US, in Mexico, and Canada. The second issue comes is, will India remain competitiveness in IT industry? The next slide, please. So if you look at the availability of STEM professionals, India produces the highest number of engineers in the world. The only country that competes with us in science is China. But China has 3 problems. One, language issue. Number 2, China is not known for intellectual property protection, unlike India. Number 3, because of now this global anti-China sentiment, it's unlikely Chinese tech companies can scale up. And if you look at the other US is anyway short of STEM professionals. Most of other countries are actually have stagnant or declining populations. And again, in terms of quality of professionals, for example, cloud practitioners, we are the highest in the world. So both in quantity and quality, our STEM resources are pretty good. The next question that comes up is, and this is a very interesting topic of rupee depreciation. A lot of people get excited when rupee depreciates, and what has happened in the last few days, that how it will benefit IT services industry. First, I just want to categorically point out, that last 20, 30 years, which are long period you look at, rupee on a long term has depreciated 3 to 4% a year. And the rupee depreciation, nothing but the inflation differentials between India and the developed world. India, 5 to 6% versus 1 to 2% in the developed world. And and if you see interestingly in the chart, in the last 2 cycles when rupee is depreciated, IT industry margins have not expanded. In fact, growth is a lot more important to expand margins for IT services industry rather than the currency depreciation. But rupee also has a very interesting nuance about IT industry valuations. A lot of people, when they model IT services companies, and all IT services companies talk about dollar growth rate. For example, if TCS or Wipro or Infy is talking of double-digit revenue growth, they never talk about rupee revenue growth. They always talk about dollar revenue growth rate. And if you add a long-term 3 to 4% currency depreciation, which has been the long-term trend with rupee in your DCF in a DCF model, then the value of the IT services companies would go up by 35 to 40%. We believe this is, and we have often seen a lot of IT industry models, both by a lot of sell side and often had conversations with buy side. And we believe that's often a flawed approach when modeling IT companies, because you can't have, to put it to argument differently, You can't have rupee cost of capital and dollar revenues. If you want to model dollar revenues, we should use a dollar cost of capital. So finally, what is the near-term outlook? What is happening in IT services? And this is a survey by McKinsey which said that because of COVID, digital adoption has been accelerated by 3 years globally and 4 years in Asia Pacific. All of us are using a lot more technology, whether in e-commerce, fintech, education, health, entertainment now. And Gartner has put out a forecast that they expect IT services industry to grow 8.5% in the next 5 years. With Indian IT services likely to gain market share, it gives a lot more confidence that Indian IT services can continue to grow in double digit. I'll stop here and my colleague would talk about our perspectives on looking at valuations in IT services and how we look at IT services companies. Over to you, Ayush.
Thank you, Ramesh. In the next section, we're going to be addressing some of the common questions that we get asked by our clients around valuations in the sector. The most common being whether it makes sense, the current valuations at which some of these IT companies are trading. What about the mid-cap IT companies? They seem to be even more expensive. What about them? And finally, I'll also touch upon White Oak's approach to investing in IT sector. So let me set the context for this discussion. What you have on the screen is how the consensus multiples for large cap and mid cap IT have moved over the last 4 or 5 years. You would notice that in the last 12 to 18 months, the multiples are clearly inching up. And many investors are worried that since the current multiples are higher than the last 5-year averages, therefore, these businesses are expensive. Now, there could be several logical fallacies around this kind of multiple anchoring, starting with that, just like for a stock price, the historical trajectory of the stock price has no bearing on what it will do going ahead. Similarly, the historical trajectory of multiples may not have a great amount of bearing on how the valuations will play out going ahead. Further, we must not forget the fact that to 2018 was characterized by existential questions being raised on the IT sector. That was a time when the obituaries were being written and a lot of people were questioning the fundamental of the business model. Many of these questions have been very well answered in the last few years, and these businesses have done an extraordinary job of adapting to digital, reskilling their workforce and making their future ready. And therefore, we would be remiss not to consider the fact that perhaps the superior economics, the durability of growth of many of these businesses were being underappreciated in the past. Perhaps the resiliency of the business model was being overlooked by investors. We must also not ignore the fact that we live in a very different world today. Our lives have changed in more ways than one, and technology has taken center stage not only in our personal lives but in that of the destinies of businesses and organizations across the world. The very fact that we are having this conversation on Zoom, a platform that most of us did not know about 1-2 years back, is a testament to the fact that how the business world has changed, and technology has become the center stage. Not only it has moved from being a cost center to being a revenue center. This is how businesses are now driving their growth. This is how they are acquiring new customers, segmenting them better, targeting them better. And therefore, the relevance of technology today is far greater than it was in any time in the past. Now, zooming out a little bit, with this context in mind, how should we think about valuing some of these businesses? We've always said that it is crucial to have a logical framework to value businesses. And the heart of it is the fundamental premise that the value of any business is nothing but the present value of its future cash flows. And just merely looking at accounting multiples isn't really valuation, it's pricing. And the way we think of great businesses is along 3 key attributes. Business should have superior returns on capital, should have a scalable long-term opportunity, and be well managed in terms of execution and governance. Ramesh in the previous section has touched upon the scalable long-term opportunity that we see in many of these businesses in the IT sector. And in the next couple of slides, I'll touch upon how some of these businesses have done as far as their ability to deliver returns on capital and how they've done in terms of execution and governance. This slide shows the average pre-tax return on capital for both large cap and mid cap businesses. On an average, large caps have delivered 50% pre-tax return on capital, and mid caps have delivered 42% pre-tax return on capital employed. It is important to look at forward superior returns on incremental capital, and even there, most of these businesses fare very attractively. Now, this superior returns on capital is underpinned by a highly capital efficient business model. You would notice, and the two sources of capital that go into any business are in the form of capex and working capital. You would notice that on average, IT businesses, the capex to sales is about 3%, and the working capital invested in these businesses on average tends to be about 17%, resulting in approximately 90% conversion of your accounting earnings to free cash flow. And this characteristic of free cash flow conversion is on average better than your median company in the index. In fact, very few other industries exhibit such attractive capital efficiency and cash flow conversions. FMCG sector would be one example to think about. Now, well, these companies do generate high returns on capital. What is it that they do with these cash flows? Here, what we've done is we've looked at if you'd invested in any of these businesses 10 years back, way back in 2010, what is the percentage of their 2010 market cap that has already been returned to shareholders in the form of dividends and buyback? On an average, 75% of the market cap has been returned by these businesses. Someone like a TCS has already returned 86% of the market cap, and a Coforge would have returned 92% of their 10-year ago market cap purely in the form of dividends and buybacks. So what does it all mean? How do we put all of this together in a coherent framework in order to be able to value some of these businesses? And with that, I come to White Oak's valuation philosophy, which we've discussed in the past with many of you. Not going into too much details, but at the two key tenets of our valuation philosophy is that number one, we focus on economic cash flows as opposed to looking at accounting metrics. And secondly, we look at cash flows net of the cost of capital. And therefore, we do not rely on the commonly used metrics like price to earnings multiples or EV to EBITDA multiples, because they can be highly distorted, misleading, or even harmful. Instead, we rely on DCF value and cash flow multiples as derived from our proprietary Up-Co approach. Not going into too much details. At the heart of this is breaking down components, invested capital and excess return on invested capital. And we've discussed with many of you that invested capital, this is a low multiple business. Here, the return on capital equals cost of capital, whereas the OpCo can be a 20, 30, 40, or even higher multiple business, depending on the greatness of business and other such factors. So now let's take a look as how IT companies fare when we try and break down their value into these two components. You will notice on your screen that on average, IT company, the percentage of value that resides in invested capital or in FinCo is 5%. And 95% of the value of these businesses reside in excess return on invested capital. This compares with, at the bottom, you can see how the Sensex compares with this. The average company in the Sensex, 25% of the value resides in invested capital, whereas 75% of the value resides in excess return on invested capital. This is an important construct to keep in mind that compared to the Sensex, on average, the component of the business, which is high multiple, is far greater than the average company in the Sensex. Moving on to the excess ROIC multiple, which we talk about, you would notice that for the IT industry, the excess ROIC multiple 2 year forward is about 29.8 times, which compares to 33.5 times for the Sensex. And as we have said, this market implied excess ROIC multiple is an important consideration into our important input into our consideration of value. And you would notice that the IT sector actually trades at a discount to Sensex, despite perhaps arguably having slightly better economic characteristics and having slightly better corporate governance characteristics on average. Another question that often we get asked by our investors is, why should we not compare IT with FMCG? After all, the revenue growth is kind of similar. The free cash flow profiles are similar. So to address this question, it is true that yes, certain parallels do exist. between these two businesses, particularly that both these industries have demonstrated steady, resilient growth historically. They've demonstrated highly capital efficient business models and high standards of corporate governance. At the same time, we must not forget that there are certain key differences as well between these two business models. On one hand, most FMCG companies tend to be domestically oriented and are either monopolies or oligopolies in specific categories, whereas IT businesses are globally competitive, fragmented businesses. On the right-hand side, we see how the multiples of FMCG sector have expanded over the last 10 years. And a callback to our initial context slide where we saw many investors comparing current multiples to the last 5-year averages. If someone were looking at FMCG businesses 10 years ago and taken the same stance that if you compare to 5-year averages, it is very expensive, one would have perhaps missed out on one of the best 10-year period of value creation in the FMCG sector. This is not to say that the same would happen to IT businesses as well, but important to have that context in mind that historical 5-year averages may not mean anything as far as the future trajectory of valuation multiples are concerned. The next topic of discussion is on mid-cap IT. The question that keeps getting asked is, what has really changed in mid-cap IT? Why are some of them doing really well? And we see two clear vectors along which these businesses have shown transformation in the last 5 years. The first is purely in terms of a far stronger leadership that is there at the helm. The leadership comes from tier one companies, the likes of Infosys and HCL Tech. These leaders were star performers in some of their previous companies and are now based in the US, closer to their customers, and have the ability to attract A-grade N+1 talent. And this has completely changed the performance culture in these organizations. In fact, many of you would be surprised to know that in some of these mid-sized companies, the compensation for getting a $20 million deal would be identical to if you were to win a $100 million deal in some company like Infosys. The other vector along which we see a clear change in the quality of these businesses is that now they have a far sharper positioning. They're not trying to be everything for everybody. They have figured out key areas in which they want to develop deep domain capabilities. And in these chosen select areas, they are competing head-to-head with tier one companies and even winning deals. A few examples, the likes of Infosys, just chosen BFS and cloud native application development, the intersection of these two as its core competency, or someone like a Coforge that has chosen reinsurance or travel technology as its focus sectors. And then within that, complemented its strategy by building capabilities around areas like APN, Pega, MuleSoft. Similarly, Persistent Systems focus on digital product engineering, complementing that with capabilities around automation, Salesforce, etc. And what this has resulted in the last few years is far stronger deal wins. In fact, 3 mid-cap companies are now over $1 billion in terms of revenue and are now eligible for $100 million plus deals. In the last 3 years, select mid-caps have led the industry in terms of growth. And as we see things today, some of them are poised to lead industry, be in the top decile of growth as far as the IT industry is concerned. With that, let me finally move on to White Oak's approach of looking at the IT services space. We see compelling opportunities across the market cap spectrum and do not have any preference for large companies. We spend a lot of time focusing on understanding the technology and service capabilities, understanding the execution DNA of these management teams, analyzing the quality of their client portfolio, understanding the profitability drivers, and then we try and assess the valuations relative to the sector. Important to make this point that we never have any top-down views on sector valuations. In fact, we optimize weighted average sector upside to 0 to ensure that we remove any sector-level valuation bias and pick the most compelling combination of great business and attractive valuations. With that, I've come to the end of the presentation on IT sector. And operator, we can move on to the next section, please.
Thanks, Prashant. Thanks, Ramesh. And thanks, Ayush, for sharing insights. We now go to the final segment of our session this evening. We have a panel discussion. So joining Prashant and Ramesh on the panel are other members of the senior investment team here at White Oak. I'd like to invite Manoj Garg, who covers pharma, chemicals, and auto, to join the panel, along with Rohit Chodia, who covers consumers and telecom. Parag Jariwala, who covers financials, and I can see there are quite a few questions on financials. And Rishi Maheshwari, who covers healthcare and real estate for us here at White Oak. Thank you all for joining this evening. And the first question, which is there from the people, is the most common question, something that we get on almost every client conversation. And I know Prashant has been addressing that question for the last 14 years since he's managing Indian equities. The question, I think, Ramesh, I'll ask you to answer this question on diversification and the number of names in the portfolio. Does having close to 15 in the portfolio make it over diversification? Does the PMS or AF become like a mutual fund? Your thoughts on that, and I'll ask Prashant also to add his.
Sure. First of all, mutual fund or PMS is just product packaging. At the end of the day, the key product is the investor returns. Number two, on portfolio diversification, considering the depth of opportunity and the diversity of the Indian market, we believe it's actually a suboptimal strategy to have a focused portfolio of, let's say, 15 to 20 stock. Let me give you an example. Let's say if a fund house is managing 15, 20,000 crores and they decide to have only 15 to 20 stocks. So then the average position in the portfolio has to be 1,000 crores. And typically fund managers don't buy more than 5 to 10% of the company. So typically such a fund house can't invest in any company that has a market cap less than 15,000 crores. And by that definition, you limit yourself to about 150 to 200 companies in India. In a country with a very large investable opportunity set, why would you restrict yourself to only a small portion of the market? It is possible that you find a gem which has a market cap of 3,000 crores. Even 1 or 2% position, when it works out well, can add a lot of returns. If you see our last 3.5 years portfolio, 6 to 7 out of those stocks were below 15,000 crore market cap among our top 10 contributors when we invested in them. And they have been the top 10. So a lot of our competing fund houses, if they had this focused portfolio strategy, they couldn't have invested in 6 to 7 of our best performing stocks over the last 3.5 years. I'll just give a particular example with Dixon. When we invested with Dixon, it had a 3,000 crore market cap. We invested 1% position in that. Now Dixon has done exceptionally well. The stock is up, 5x. And that single 1% position has added 500 basis points, about 450 basis points return to the entire portfolio. So why would, as investors, we pass on that opportunity? There's another reason some fund houses have lesser number of positions. It's simply because they have smaller investment teams, and that's why they can only focus on a number of stocks. Since we currently have a 15-member team, which is a very large team and with rich expertise across sectors, we are able to identify opportunities which are often not covered by brokers, including investing in ability to identify companies that are going public that are excellent by doing a lot of work on before the IPO on those companies. So it's a mix of factors, and that is why we believe for a market like India, a diversified portfolio is better for investors, and something that we have demonstrated 3.5 years at White Oak, and Prashant also in his previous organization. Prashant, if you want to add more to this.
Just to add, no, Ramesh, you covered it very well. This is a question, as Vivek said, I've been answering for the last 14 years. At Goldman, I always had 75 to 100 name portfolio. And that did not come in the way of generating top 1 percentile return while I was at Goldman. And here, as Ramesh said, the team is managing about 50 name portfolio. And that, in fact, forget about coming in the way. Having a larger number of names of portfolio actually helps generating higher returns because of the reasons that Ramesh mentioned. If you have this artificial number of 10 to 20 names or 15 names or so, this constrains you. These are actually marketing gimmick, high conviction portfolio, high concentration portfolio and all. It has a lot of negative consequences. All of them we won't be able to cover on this short call. And in fact, someday I might write a book on this, but when we meet with you one-on-one, we can cover more. Oftentimes you get stuck with a bad, if you were to invest in a 5 to 10,000 crore company, position of such large position that you can't invest in. But if you end up owning 5 to 10% in one of these companies and then you want to exit, you can't exit them very quickly as well. So it is better to own, prudent to own a 1% position or a 1.5% position in many of these names. There are 3,000, 4,000, 10,000 even crores of companies, rather than saying we'll completely ignore this set of companies and only focus on 150 in the top, which anyways everyone and their brothers are also looking at the same set. So why give up on gems of opportunity? In a way, investing to begin with is a highly competitive sport. Like IPL is going on, talking about sports right now. To have a marketing gimmick like we only have concentrated or high conversion portfolio, it's like equivalent to having your slip fielders in a catching position with their handcuffs on. They'll be able to take some catches, no doubt, but it severely constrains maneuverability and is not optimal for the fielding, if you will. So net, the higher number of names is a flexibility we can afford. In fact, it's a flexibility we have planned for by having a highly resourced expert team which can capitalize on inefficiencies in mid and small cap space as well, rather than artificially restricting oneself in the top 150 names due to satisfy some marketing message that is very convenient. And we are just the distinction between PMS and mutual fund. If I were to add for a minute there, what Ramesh already said, that it's, that's all packaging, only packaging. There is no reason why we should think of ourselves as restricted as an investment option only for PMS investors. PMS or mutual fund is an envelope. What is inside the envelope is what is going to generate the return, right? And if regardless of the envelope, if we are able to generate top performing results, then we are equally a viable option for PMS investors as well as mutual fund investors, as long as obviously the regulatory criteria of the minimum thresholds are satisfied.
Sure. Thanks, Prashant, and thanks, Ramesh, for that clarification. Parag, coming to you next. As Ayush pointed out from the portfolio composition slide, we have a large position in financials. There are questions around what is the impact of the second wave that might be there on NBFCs and banks. And as a segue to that, we can also talk about the impact of the Supreme Court ruling on moratorium and interest rates.
Sure, Vivek. So see, firstly, as you see, first lockdown was more severe and prevalent everywhere. Despite that severity, we have seen only 125 to 200 basis point impact on the asset quality of all the lenders. Of course, the large private sector banks have done far better than the industry due to their strong underwriting practice. Now, as you see, the second lockdown is relatively more liberal, plus local, and some activities being allowed. So I think businesses have found a way to function despite some restriction. We don't see large job losses. IT startups are hiring. So we don't see much material impact on the retail asset quality of banks. And this lending is backed by a lot of CIBIL data and their own database. So retail, I'm not much worried about. And on the corporate side, the large corporates have gained a lot of benefits due to commodity price rally, which we are seeing. So 40-50% of the book of most of the lenders is towards the large corporates, which are in some or other way connected to commodities. So there will be very negligible impact on the asset quality. And I think, the second wave, once it is settled, we will not see much of the asset quality impact. And at the same time, the growth will sooner or later pick up once, the business activity comes back to the normalcy. So that is on the second wave. The second question on the Supreme Court ruling. See, the Supreme Court ruling has two parts. So one is on the NPA classification, and which is actually good that the uncertainty is out. So you can classify the assets which are not paying on time as NPA, start your recovery process, and recover whatever you want to recover. The second part is about extending the benefit of compounding interest waiver on all loans versus less than 2 crore loan, which was been given earlier. So if you see the court ruling very carefully, they've just said that RBI or government should explain the logic of giving benefits only to less than 2 CR worth of loans. So there is a fair chance that the verdict, of final verdict, whenever Supreme Court comes out, it would be in favor of banks or NBFC. But let's assume the worst case. If the banks and NBFC have to bear the cost, the potential impact, as per our calculation, should be around 14,000 to 15,000 odd crores, which translate into around 10 basis point impact on NII or around 4% on their PBTs, which is, I would like to note that is only a one-time, one-quarter impact, right? The long-term story of the private sector banks gaining market share over PSUs, the stronger one, doing far better on the asset quality, margins, and growth remains intact.
Thanks, Parag, for that. And maybe just continuing on the impact, let me ask Rohit what he sees as the impact of the COVID on consumers in names like DMart, Titan. If you can just throw some light on that, Rohit.
Sure, Vivek. See, these are two high-quality retailers. If you look at, before coming to them, I mean, if you look at the impact on retail in general, of course, the short-term impact as people, again, are constrained to move out, etc. The short-term impact on retailers is going to be high, barring a few names which may benefit, someone like a Jubilant, because home delivery in food is allowed, that gain share. But by and large, the short-term impact on retailers is going to be high. What this, short-term challenges will also bring to fore is the relative quality of some of these businesses. So you have to, two basic factors about, the high-quality retail businesses in India do not change. One, the addressable market remains very large. There is a very long, secular growth opportunity as some of these consumption categories, gain penetration, and the unorganized to organized shift in retail industry continues. The short-term challenge will clearly, make life difficult, and some of the low-quality businesses, balance sheets which are not well capitalized, companies or managements that are, sort of short on execution quality. Some of those businesses will get exposed, but businesses like a DMart or Titan, two names that you mentioned, or a Jubilant Foodworks, I would, expect, or I would see the current challenges actually as relative positives as some of their competition gets impacted. Number one, in fact, if you look at just the last 1 year, the way some of these businesses bounced back, a DMart in the third quarter, fourth quarter again, got impacted a little because of lockdowns in March. The way Titan came back, reporting, a very solid, 2-year CAGR in the March quarter. Of course, the YOY number was close to 70% in jewelry. Tells you the inherent competitiveness of some of these businesses. So I would, continue to be positive on the long-term growth prospects of the quality retail businesses. It's important to differentiate between high quality and low quality names here.
Right. Thanks for that. So, Prashant, there is a question, and maybe I'll request Manoj and you to answer this. Is that you spoke about the second wave and that the market impact may not be as severe, but there is a question that are the numbers being reported the actual numbers? Are states or segments of the population underreporting? If the actual numbers were to be reported, would it cause the markets to fall? Would there be impact on the market? And Manoj, I would also request you to add, what are you hearing from pharma companies on the vaccine rollout and any impact that you see in pharma companies? Maybe Prashant,
Manoj, why don't you start, Manoj, on the pharma companies, what you're hearing?
Sure. So thanks, Vivek. So if you look at today, there are 3 vaccines which are being approved for the emergency use authorizations. And if you look at the combined capacity of these 3 vaccines, which they produced last month, was around 64 million doses, which probably this month is likely to be around 75 million kind of doses. And I think as Prashant has highlighted earlier, that today we look at the total number of people who have already been vaccinated is around 7 to 8% of populations. Now, when you look at the pharma companies or the vaccine companies' plan in terms of ramping up their capacity, this number which I'm talking about, 74 million vaccines per month, is likely to go up to almost around 180 million by September 21 and 270 million by December 21. Or in other words, by that time, if whatever these guys are talking about in terms of producing the vaccines, probably we would be having 60% of the populations vaccinated by that time. And if you look at from a spread perspective or R0 perspective, which is something which is being used very commonly and in the medical parlance, that if we will have 55% of the population which is being vaccinated, then probably we would be able to bring the R0 below 1, which is very, very critical in terms of containing the infection. So in terms of vaccination, probably while today we are vaccinating maybe 2.5 to 3 million people every day, my sense is that with government now coming up and they have approved Sputnik V last week, and they've also indicated that they are open to approve other vaccination which have been approved by regulator like US FDA, UK MHRAs, etc. Probably, I think that maybe 2 months down the line, we would have a pretty relaxations in terms of manufacturing of vaccines. I would also like to add here that currently we are also seeing the shortage of the therapeutic drugs which are being used for the COVID treatment. But what we have heard from the companies like Cipla, Dr. Reddy's, Cadila, and even Sun Pharma now, they say that by 20th of this month, they are going to increase their capacity by almost around 200%. So while obviously the virus is being spreading at a much faster pace, and it has already crossed maybe what we have seen the peak last time, my sense is that probably we will have maybe a more comfortable situation, both in terms of vaccination as well as treatment over the next 3 months. Over to you, Prashant.
See, the market obviously understands that the actual number of cases is far higher than what is being reported. And that's just the fact around the world, including in Western and developed countries. The factor of underreporting may be different, and it's just not underreporting purposely or something. It's just a combination of variety of things. In the first wave, there just weren't enough tests available, or testing centers weren't available. People don't even come forward to get tested. So many people are asymptomatic, they don't even realize that they had COVID. Many people, the symptoms are so mild. People say, why bother go out there to test? I mean, if it gets worse, then I would do testing. Many people believe, well, what is it going to do? Anyways, they're going to do the same thing as I can do at home if the symptoms are not so strong. So they may not get reported. And that's true worldwide. And these stories have firsthand heard from friends and clients around the world, and it's well documented as well. Even in Europe, where the reported number of, let's say worldwide, the reported infections are about 140 million, which is 14 crore people, right? Out of world total population of 780 crores. So nobody in their right mind would believe that only less than 2% of the population has been infected thus far. So the reported numbers nobody trusts. Everyone understands that's 10 to 20 times possibly undercounting. And in India, total 1.4 crores or so is reported number of cases. Um, we think it can easily be, a factor of 10 or 20, similar to the world, or even higher, that have already taken place. And hence, the mortality rate, which worldwide, if you just take the number of deaths, which is 3 million, 30 lakhs, on reported number of cases, which is 14 crores, it would appear like 2% or so is the mortality rate, which was what the initial fear when the numbers were just getting reported, started to get reported. This mortality rate was 4 to 5% or even higher. But very soon people realized, very soon, last year in March, realized that the underreporting is massive. And hence, even today, the mortality rate is not 2 in 100. but possibly 2 in 1,000, 1 out of 500 or something, which is what I mentioned earlier. So that I mentioned earlier, with the assumption that everyone understands the actual number of cases are a lot higher than what is being reported. On a reported basis, 2 out of 100 people who are contracting are dying, which is not at all true from antigen tests. Like in Bombay last year, when surveys were done, antigen tests already were showing 30-40% of the certain sections of Bombay were already COVID positive. Whereas on reported number basis, that might be single digits. So the market fully is aware of actual number of cases to be 10, 20. If you and I are aware, market is aware of it far ahead of us.
Thanks, Prashant, for
See,
that.
it's actually a positive. It's actually a positive. If in reality, market believed that the total number of cases in the world are only 14 crores and 30 lakh people have died, or total number of cases in India are 1.4 crores and 1.7 lakh have died, that would be far more worrisome, where the mortality rate would be 2%, and then people would lock themselves up at home. So the fact that market understands actual number of cases are a lot higher is comforting to the market. And that is why the market started rallying last year, as soon as they realized that the actual mortality is a lot lower, and mortality is lower only because the number of cases are a lot higher and being underreported.
Right. Thanks, Prashant. Rishi, let me come to you next. I think there is some excitement in the real estate segment. What are your thoughts, especially on the residential side? And are you seeing investments happening in the real estate space, and are investors looking at that as an asset class to invest in?
Thank you, Vivek. Good evening, everyone. In the interest of time, I'll try to highlight sort of key facets of why we believe sort of residential demand has changed. Post a lot of the headwinds that the sector faced about 3 years ago, whether it was demonetization, GST, RERA, as well as the liquidity crisis. The COVID outbreak has totally changed the residential sales trajectory. As many of us saw in the second half of last year, we've continued to see the sales trajectory in the recently concluded first quarter, where sales on a year-on-year basis increased by 44%, albeit considering that last year would have had a May impact given the lockdown. Now, the key factor that's kind of attributing this demand is affordability, which is centered around sort of key points, including sort of 15-year plus low mortgage rates, sort of lack of price hike across key markets in the country over the last 5 or 6 years, and this coupled with income levels increasing over the past 5 years, slightly higher than 10%. Again, if you see on an EMI to income ratio, we are at the lowest in over a decade. Extreme price discounts in certain markets by developers, coupled with a reduction in government duties in Maharashtra, which we've all seen, and good hiring by certain industries. I'll name, I think Ramesh and Ayush pointed out during their presentation, including IT in some of the key cities, including Bangalore, Hyderabad, and Chennai in South India. All of this kind of led to increasing sort of affordability from a consumer base. What this resulted in, and the biggest beneficiary of this, was listed real estate developers. And if you see the trend towards their market share increasing, and if you see a recent study that was done by Anarock over the key 7 cities, if you look at pure play listed residential developers over the last 5 years, their market share is actually estimated to have increased by 3x, from 6% to over 18% over this sort of 5-year period. And again, I think in our view, and Vivek, the key point to answer your question is the divergence between growth rates for the industry versus the listed players, we believe is going to continue to remain. So the trend is here to stay, Vivek.
Certainly, Rishi. Thanks for that. Ramesh, there are quite a few questions after your presentation on IT and IT services. I think there is a question where we own both traditional IT service company like Infosys in the portfolio as well as InfoEdge and Matrimony. Just your thoughts between internet companies and versus IT service companies.
Yeah. So first of all, InfoEdge and Infosys are two very different businesses. One is the IT services business. One uses technology as an internet as a business. So, and the one addresses like InfoEdge largely is on the domestic markets, whether jobs or real estate advertising, and of course matrimonials, and then they have stakes in Policy Bazaar and Zomato. So, the business models are very different. So it's like apples and oranges comparison. Of course, talking about the internet businesses, and as of now, we only have a few listed companies in the Indian universe, and we have a very large pipeline of companies that will go public in the next 2 to 3 years. There's a large tech IPO pipeline. But let's say businesses like InfoEdge or Matrimony or IndiaMart, these businesses are significant beneficiaries of the acceleration of adoption of digital technologies by consumer because of COVID. Anyway, because of lower data cost and the disruption that Jio had caused in the telecom market, there was a huge uptake in mobile internet in India through smartphones and apps. And COVID has only accelerated those behaviors. Today, like for a lot of these platforms, 80 to 90% of usage comes from either apps or mobile internet. So clearly, and the longer COVID stays, the more these behaviors will stay forever. Adoption of technology. So structurally, for these companies, this is a mega trend that has worked for them. And a lot of these companies, particularly if you have strong leadership in large potential markets, for example, InfoEdge is strong leadership in jobs. Again, number one leadership in real estate portals. And of course, they are very attractive investments. They are made in Zomato, Policy Bazaar, or IndiaMart, which is clearly the strong leader in business-to-business marketplace, B2B marketplace. Now, these businesses have very strong prospects. They are market leaders. These businesses are extremely profitable, and all these companies have strong track record of execution. So, and of course, these companies generate free cash flows. In fact, free cash flows are higher than profits for some of these companies because you get paid in advance. So we find overall this space to be opportunity, these kind of companies to be very attractive from a long-term perspective as investors. And we are going to see a very interesting pipeline of IPOs that are going to come in the next 2-3 years.
Sure. Thanks, Ramesh. In fact, I think there is a question on IPOs. Maybe I'll ask Prashant to share his thoughts on a fair number of Indian startups looking to go public in the next 5 years. What is your view on that, Prashant? If you can just provide your insights. And do you see a lot of opportunities coming your way from an investing standpoint?
The team always has looked at IPOs over the last 4 years, and myself, when I was leading at Goldman, have always looked at IPOs, and so we would be looking at every opportunity and participating. The team would be participating in where we find attractive opportunities, and it's not just in technology. Over the last couple, 3-4 years. Even last year, company like Manoj covers Rosari Chemicals, or this year Lakshmi Organics. These are in various sectors that there are opportunities that are there, and we remain open. The team remains open to all of these. IPO time can be initial listing day can be inefficient because people don't have long history or sell side reports, or otherwise haven't done their work adequately, and so offers us the opportunity to a team which is very well prepared and has done its groundwork in a disciplined manner ahead of time to capture potentially great opportunities. And if the question is particularly related to the online e-commerce space, yes, very much so. We remain focused on those opportunities.
How would you value these companies, given that many of these companies do make a lot of losses? So just thoughts on that.
The OpCo FinCo framework is ideal because there is no earnings, no PE. So those who are stuck with a PE mindset or EV/EBITDA mindset are at loss to value these companies. Whereas in our OpCo-FinCo framework, which is a DCF-based framework, which we are projecting forward the cash flows, and all that OpCo-FinCo framework is doing is whether next year or whether companies producing cash flows today or producing cash flows in future and not producing today, it breaks up the value into two components. What is the value of just dumb capital and what is the value of excess ROIC? And that is perfectly, possible to do even in companies, just like in regular DCF value. So OpCo-FinCo framework basically breaks up the standard DCF into two components, dumb capital and excess ROIC, and hence is more suited to value such companies than a PE-based approach or a EBITDA multiple-based approach.
Thanks, Prashant. Manoj, coming to you next, the question on autos. What are your views, both in the near term as well as in the longer term for the auto space in India? And in specific, your thoughts on electric vehicles and the impact that it might have on auto companies? And how is the portfolio positioned for that?
Sure. So if you look at the automobile sector in India, and not only in India, I think across the globe, is going through with a very, very interesting and exciting phase, where one end you are seeing the transition happening maybe from a 100-year-old industry of IC-led kind of vehicle to an electrical vehicle, which you've just spoken about, or maybe people already in the developed markets have started talking about the autonomous vehicle. I think if you look at in maybe 5 years ago, probably people were a little skeptical whether the electrical vehicle will happen or not. But today, I think one thing where people have come into agreement that electrical vehicle is going to happen. Maybe one can argue in terms of the timing, whether it will happen in next 5 years or 10 years. The other interesting thing which you look at over the last 5 years, the battery cost, which was considered to be the major overhang in terms of the acquisition cost for any electrical vehicle, it has come down by 20% CAGR. And what people are saying that maybe over the next couple of years, the battery cost may come down to maybe or around $100 per kilowatt. And that is a point where people will start talking about the parity of that cost, when it comes to the IC vehicle. Now, even if, while I understand that there are other ecosystem challenges, like maybe people talk about the infrastructure with regard to charging infrastructure, range anxiety and all those things. But I think if you look at in the past, as the technology get a little more matured, all these kind of issues are being sorted out. Now, how do we think about EV ecosystem in India? We are pretty clear that EV in India is likely to happen. Maybe there could be a varying kind of degree in terms of where it will happen or where it will come first and how it will affect the rest of the ecosystem. So to us today, it looks like that maybe the three-wheelers followed by two-wheelers and then the maybe public transport. And those are the segments which would be more, I would say, vulnerable in terms of EV adoptions over the next 3 to 5 years. Many of the companies in this space, the likes of Ether Energy, Ola, Hero, and many other such companies have a very, very aggressive plan. And I think the incumbents in two-wheeler and particularly the mass and commuter segments are likely to be under pressure if they will not be able to have a credible products or are able to retain the market share. The second thing, what we think about in terms of the EV adoption for the PV or passenger vehicle, given that India is still largely a small car market, where the average selling price is less than 500,000 rupees, we believe that maybe the adoption of EV in the passenger vehicle is still some time away. While companies like maybe Tata, Mahindra, Hyundai, or even MG have come out with some products initially. But again, I think the adoption is likely to be 5 to 7 years away. And if you look at today, Maruti, which is the leader in this segment, has clearly have highlighted that they are going to put up probably the first electrical vehicle manufacturing facility in India, along with collaboration with Toshiba or Denso, or even their tie-up of Suzuki with Toyota will allow Maruti to have that access to that technology, in terms of EV as and when the ecosystem develops. Now, answering your question that how we think about automobile sector when we think about portfolio at White Oak, clearly, like what we focus at White Oak is long-term sustainability of the cash flow. And we do believe that many companies which are exposed to the internal combustion value chain, they may have existential threat if they will not be able to evolve their businesses or business models going forward. And so far, we have stayed away with those companies which are more exposed to that internal combustion value chain, such as like battery companies or maybe the oil companies. And we have only focused on those companies which would be least affected, and they have the usage whether you have IC engine products or maybe the electrical vehicle products. Thank you.
Thanks, Manoj. Shifting sectors again to telecom, and Prashant, wanted to ask you your views on the telecom sector. Both, what's been traditionally your view, and how do you think the sector is going to play out going forward, given there could be an increase in the average revenue per unit, and would the companies benefit, and would it fit into our investment philosophy?
So I'll again also request Rohit to jump in at some point if he sees fit. But let me just, a lot of you might know and might have participated in other calls or have heard me. We used to own Bharti some time ago, which we exited at some loss after realizing that the thesis wasn't playing out as we had anticipated. So when we had invested, probably before COVID and late 2019, if I recollect. This is going back before Rohit, you came on board. So that was a time when there was a evolving 3-player or 2.5-player market with Jio, Bharti, and rest all put together eventually to be half a player. And in our view, it would ultimately evolve effectively into a 2-player market in terms of sharing of the profit pool. However, what happened over the last year, nothing to do with COVID necessarily, but one of the competitors, which is Jio, raised tremendous large amount of capital to the tune of more than $30 billion. And it was on the back of divestments or stake sales in entities like GeoMart or Geo networks or platforms primarily, where number of subscribers on the platform is a particularly important metric in terms of value creation. So in our assessment, first of all, there is one competitor now which earlier had balance sheet which was getting stretched, wasn't stretched necessarily, but a balance sheet which had substantial debt and would not have been wise for them to engage in a prolonged, the balance sheet was in a shape that it made sense for Reliance to, let's say, settle for a 2-player market. Now, with the balance sheet problems taken away, and secondly, all the money being raised and the valuations being accorded to businesses where subscriber numbers is what matters more rather than profitability of the telecom business, telecom can end up being a loss leader for Reliance, for Jio. It's like in a grocery store, it's often said that milk is the loss leader because someone comes in to buy milk where the grocery store doesn't make money or even loses money, but in the process they end up picking up several other things where the grocery store makes money. So it is similarly, we felt there was this serious risk in case of Reliance, where telecom business can become, if not a loss-making business, but a low profitability business, and it would be fine for them because they are making money in various other ways. And someone like Bharti would be negatively affected because that is the bread and butter for them. So we exited Bharti. We never say at this point in time, we continue to observe how things evolve. We don't know for sure how things would evolve. I don't think anyone knows how things would evolve in this situation, can be sure of how things would evolve, and will take a call in future. We remain open to investment again if if we see that the competitive dynamics are evolving in such that it would become a profitable business, not just profitable business, a superior ROIC business for any of the players, including Bharti. I don't know, Rohit, if you want to add anything to that.
No, Prashant, you covered it by and large. I think I'll just repeat that we'll continue to observe the way things pan out, from here on. If you look at the history of this sector for the last 12, 13 years, and in Bharti's context, while on one hand the company has continued to execute very well, the context has remained challenging. So starting with Tata Docomo's entry, and you go back to the Reliance Communications, Aircel days, the era of the 2G, 3G wars, this sector has, historically players have focused on market share grab. The focus has been on the slice of the pie, and the pie in fact over time has shrunk, right? So now the industry over time has consolidated, and that should logically at some point mean that the focus shifts back to expanding the pie or the profit pool. Though the risk therein is, if a geo continues to see connectivity or telecom business as a loss leader, that can help them create value in some of the digital assets. If that's the view they take, then this profit pool is expansion is going to remain a challenge. But that's something we are watching very closely, and if we see a sign that there is a mindset change, or we see signs that that connectivity profit pool is something that Reliance would seek, we have a lot of comfort on Bharti's execution and their ability to gain or get their fair share of this profit pool. So that's how I'll sum it.
Great. Thank you, Rohit. I think we have kind of already overshot the time, and there are lots of questions still to go. So what we will do is we'll reply to all of them separately on email. But I have one final question, and I'll ask Prashant to answer this. Prashant, this is a question that if the team has been getting, and we get an everyday basis. Is this a good time to invest in the markets? What would be your thoughts on that? And maybe. And I know the answer, and everybody knows the answer, that you don't time, and all your net worth is in Indian equities. But Prashant, if you could just highlight what you think about timing and speak about having a very balanced portfolio and looking for the most compelling combination of business and value.
So before I answer that question, I will correct Vivek. We won't be able to answer every question on email. The investment team would not be able to spare that much time. We can, during interaction with clients and other forums, would seek to address if we haven't already addressed them. Not knowing how many more questions there might be, just going by last time's experience. Second, coming to the question though that you asked, yes, there is a lot of talk about value versus growth and all these things, as well as time in market. I've spoken at length. The team have spoken at length. Again, going back to will strongly encourage everyone to read, because that is our view as well. The newsletter that we wrote a few months ago. Over the last 35 years, I've been personally fully invested at all times, 100% or thereabouts in equity markets. In a younger age, much more, and now closer to 100%, if you will. Each one has to figure out what is their comfort zone in terms of equity allocation to equity. For me, it may be 100 equity, others may be 75, 50, 25, whatever it is. Equity remains the most attractive over time asset class, one that I believe would provide returns higher than at least actively managed portfolio that we manage, in my biased opinion, would provide better returns than any other asset class. Obviously, it does not come in straight line. If you want a straight line, you have to invest in fixed income, but fixed income is guaranteed real loss, not only in India, but everywhere in the world. You cannot keep up with inflation in fixed income after paying taxes. Right? Otherwise, Rockefellers would still be the richest folks in the world. The way interest rates are everywhere in the world, by the natural law of finance, you can say, or investment, if someone wants to have a risk-free return without doing any work, they would become poorer in real terms over time. And that is the reason why, in many countries, interest rates are negative. So oftentimes you see these headlines that in Denmark, people are getting paid to borrow money to buy houses, right? And there are negative interest rates, and people wonder, why are people putting money in the bank if there is negative interest rates? Why are they paying banks to keep money? That is because you can't keep money at home, because you might lose your life. It's jaan ko jokham, as they say, if you keep money at home. But the reason it's negative rates in many countries, including Japan and Europe, is because inflation is close to zero. If inflation is zero or negative or close to zero, interest rates have to be negative to fit to that thesis that I talked about, that after inflation and after taxes, returns are negative everywhere in the world, and that is fixed income. And hence, just to elaborate, while you feel the comfort and pleasure and sleep comfortably at night by investing in fixed income, that does cost money. In nominal terms, in India, you can earn 5%, 6%, whatever. But after paying taxes, you'll be left with 3%, 4%, which isn't going to cover, inflation over time. So while sleep is very important, you just have to realize that it comes with a cost associated with it. And it's not that you're earning or growing your wealth, it is declining in real terms. So timing, never tried timing, because to us, timing is like coin flip. You can do PhD, but be no better than layperson in predicting the next coin flip. Same is true for market timing. There's complete randomness on that front. Markets can over time generate low double-digit returns, which is in line with nominal GDP of India, nominal GDP growth rate of India. It has done so over the last 20, 30 years. And in my belief, it's fair to expect it to do over the next 10, 20, 30 years. It has been the case not only in India, but also worldwide. Most countries worldwide, over extended periods of times, rolling periods of time, deliver, like in US, like in Europe, in line with nominal GDP growth rate over multi-decade time frame. And same is true, and that is the only known fact. Logically predictable fact. It's like, to give you another analogy, if you ask me whether it would rain in Bombay on July 26th, very hard to say, right? You can see historical record in one of the years, 2006 or something, it flooded heavily, this, that, and the other, but in other years, it might have been dry. So similarly, next 12 months, next 24 months, it may rain. I mean, in the markets, you may make a lot of money, you may not make a lot of money, you may lose a lot of money. It's impossible to say. But over longer periods of time, it's like asking the question whether it would rain in Mumbai in the month of July. We can be quite sure, and I can bet my house that it would rain in Bombay in the month of July. And similar is our confidence over longer periods of time. The market should deliver returns in line with nominal GDP growth rate, which is low double digits in rupee terms. I would expect the team here to deliver substantially higher than that, commensurate with what is required to be top of the peer group ranking in this game, if you will. Historically, that has been about 900 basis points or so, as Ayush went through the talk on a gross basis, and that would be the expectation. And so would not try and time, consistent with our past, would remain fully invested at all times.
Thanks a lot, Prashant, and just like to thank the entire team for taking time today. With that, we'll conclude our quarterly event at this point. I'd like to thank all the people who joined us today, all our clients, for all the questions and for being a very participatory audience. Thank you for taking the time. Please stay safe and look forward to seeing you all again next quarter. Thank you.
Thank you.
Everyone for taking the time. Thanks for the investment with us. Thank you.